Let me introduce today's speaker. Today's presenter is Linda Wang. She serves as the National Timber Tax Specialist with the U.S. Forest Service. She is an author and educator on federal tax policies, includes presenting timber tax issue at Congressional Seminar on Capitol Hill. She has a CPA certificate and a PhD in forest economics. And with that, I'm going to turn it over to Linda.
Thank you, Bob. Hi, everyone. I'm Linda Wang from Washington, D.C., and welcome to our program. I want to thank our partners who brought you this webinar, Southern Regional Extension Forestry, NC State University's Extension, and Texas AgriLife Extension. The goal of our program is to empower you, to help you take the best tax positions according to the law and make an informed decisions on tax reporting of timber transactions that many tax professionals are unfamiliar with. The tax laws are complex, and the part of the law that applies to timber are not intuitive in many respects. Timber tax law is a highly specialized area that's different from other general business and farming tax rules. And the tax laws are constantly changing. In December, Congress passed a tax law that also affects woodland owners. I will discuss general tax rules, special timber rules, and new law changes all in this 1-hour webinar. So today's discussion is educational, not legal or accounting advice. First, let's look at the important issue of tax rates. Ordinary income, such as wage and salary, Social Security income, are taxed from 10% to a maximum of 39.6%. However, if your income qualifies for long-term capital gains, the tax rate is 0% to a maximum of 20% only. Long-term means owning your property for more than 1 year before you sell it. So if you have long-term capital gains, the 0% rate applies when your taxable income is $73,800 or less for joint return. For single taxpayers, that's $36,900. A maximum rate of 20% applies to your long-term capital gains if your taxable income is over $457,600 for joint returns or a little over $400,000 for single taxpayers. Otherwise, your long-term capital gain tax rate is at a maximum of 15%. In addition to the capital gains tax, there's a 3.8% net investment income tax. This 3.8% net investment income tax was a new tax that started in 2013, and the tax is imposed on the lesser of your net investment income for the year, or the excess of your modified adjusted gross income over $200,000 for single taxpayers, or $250,000 for joint returns. So the net investment income tax applies only if your modified adjusted gross income exceeds the specified threshold amount and the taxpayer has net investment income. So here's an example of how this 3.8% tax works. husband and wife have $270,000 adjusted gross income, including $50,000 capital gains. The excess of $270,000 over $250,000 is $20,000. So that is less. $20,000 is less than the $50,000 capital gains, and their net investment income tax is $760 or 3.8% of $20,000. And the definition of net investment income include interest, dividends, annuities, royalties, rents. It also includes net gain from sale of investment property, which includes timber sales when you own timber as an investment property. It also includes net gain from sale of passive business property. That also includes timber sales when your timber business is passive. Passive business means you do not materially participate in the business. So as you can see, your tax status is key. If your main purpose of owning your timber property is for recreation, fishing, personal retreat, and enjoyment, your timber property will be taxed as personal property. The disadvantage of personal property status is that your deductions are very limited, although income on the sale of personal property is still capital gain. If your primary purpose of owning your woodland is for generating profit from growing timber, your property may be taxed either as an investment or business property, and you can take tax deductions. The difference between investment and business are not clearly defined. It depends on the specifics of each case. But in general, a business carries out timber activities on a more regular and active basis than an investment. If your timber ownership is a trade or business, it may be subject to the passive loss rules, and that determination must be made for each tax year. I'm going to have a quiz here for you. If your adjusted gross income is less than $250,000, your capital gains are not subject to the 3.8% net investment income tax. True or false? Please go ahead, make your selection on your computer. Okay.
Folks, a quick reminder. Please, if you're calling in by telephone, please place your telephone on mute. That will help that with the background noise that we're picking up.
All right, thank you. Most people already made their selections. This is true. The $250,000 is the threshold. So if your adjusted gross income, whether you're filing single or separate, married filing separate or married filing joint return, if you're married, if your adjusted gross income is less than $250,000, this tax does not apply to you. All right, let's look at the new tax law change. A new tax law was enacted in December 2014 that increased the amount of tax deduction on depreciation. Now, you can take depreciation deduction on machine and equipment, for example, tractors, logging equipment, computers, temporary road and bridge, if you meet the profit or income generation requirement. And let's look at what the new tax law says. First, in 2014, you may now expense up to $500,000 you spend on buying qualifying property if you are a timber business taxpayer. This is the so-called Section 179 expensing. The $500,000 expensing is a significant jump from the limit that was set prior to the tax law change. In addition, a 50% additional depreciation deduction is allowed for qualified property in 2014, and this is the so-called bonus depreciation. Before the new law changed, this provision expired at the end of the 2013. The new law extended the provision for 2014. Timber sales. Let me ask you a question first. Timber sales are not taxable because the current tax law allows special tax incentives to the timber resource. Is this true or false? All right, I think I saw most of the response are false. I do see a few responses true. The answer is it's not right. This is not correct. Timber sales are taxable, but they do enjoy a special tax incentive. Now let's look at the incentive here. Sale of investment timber. Sale of standing timber held as an investment is a capital gain. What about sale of business timber? For timber business taxpayers, sale of standing timber held in a business is a capital gain too. That's Section 1231 gain for the CPAs here. If it's held for more than a year, that's the requirement. This special rule applies to both outright sale or pay-as-cut timber sale under Section 631B. Now, sale of felled timber is subject to different rules. In such transactions, all gains are ordinary income unless a Section 631A election is made. The part of the income from standing timber appreciation are still capital gains. The part of the income from a felled timber sale, are ordinary income. So there are two parts of the income for this kind of transactions. And the timber must be held for more than a year to qualify. And this is the so-called election to treat cutting as sale under Section 631A. Just remember, capital gains for this kind of transaction does not apply to the felled timber after cutting. You report sale of investment timber on Form 1040, Schedule D, and also Form 8949. For timber sale in a business, you report the capital gain or loss from the outright or pay-as-cut sale of standing timber on Form 4797. The election to treat cutting as sale have a little bit different reporting. Remember, this is where the Section 631A election is made for this kind of sale. So you make Section 631A election by checking the yes box on Form T, Part 2, specifically line 18A. And then you report capital gains, which is Section 1231 gain, on Form 4797, and then report the ordinary income portion on Form 1040 Schedule C. Let's look at timber depletion. What is timber depletion? Well, depletion is a deduction from the timber sale income. So it reduces your sale proceeds, so it reduces the tax that's due from the timber sale. Now, depletion is calculated using the timber basis. So what is basis? For purchased property, your timber basis is the cost you paid for the property. We're only talking about the timber portion, and that is separate from that of the land. So I want to show you an example. 10 years ago, you bought 40 acres of forest land for $48,000. You also paid $1,900 for accounting, consulting, forester, maybe legal attorney fees. The timber at the time was worth $29,000. So the question here is, what is your timber basis? Is it $29,000? Please go ahead and make your selection. Is it yes or no? Okay, so we are evenly divided on this, almost, yes and no. So the answer is no. It's not $29,000. So I'll show you how the calculation is done correctly. It turns out we need two more data to calculate timber basis. The first one is the land. The land itself was worth $15,000 10 years ago when you acquired the property. Also, the forester had done a cruise for you, the inventory of your timber product. So at the time that $29,000, the appraisal, that $29,000 timber consisted of 72,000 board of saw timber, which is worth $19,000, and 560 cords of pulpwood, which is worth $10,000. Once we got those numbers, we will calculate a ratio. All right, let's look at the first column. Actually, you bought three assets. You bought land, saw timber, and pulpwood. Saw timber and pulpwood are different. Saw timber is more valuable, so you actually bought three assets in this case. And let's look at the second column here, fair market value. So we got those numbers and we put them in this column here. And then we calculate a ratio here. 34% is, you divide $15,000 by 44,000, that gives you 34%. So you spend about 34% on land, and you spend 43% of the cost that you paid for your property. You spend about 43% on saw timber and 23% on pulpwood. With these ratios, now we can calculate the basis for land timber. So we just copy the ratios over in the first column here. 34% goes to the land. And we're going to ask you, where is 49,900? Where does this number come from? This number is $48,000 that you paid for the property, plus $1,900 that you paid to accounting, foresters, those various fees. So adding those two numbers together, that's your total out-of-pocket cost, $49,900. So $49,900 times 34%, and that gives you the basis of $16,966 for land. And similarly, for saw timber, 43% of $49,900 is the basis for saw timber, $21,000 and change. Same thing for pulpwood. So if you add 21 plus 11,000, this two number for the saw timber, your timber basis is about $33,000 and a little change there. So it is not 29,000, although in this case, if you use $29,000, it's conservative estimate. It's not, you're not getting the maximum tax savings, but you didn't claim more deduction than you would otherwise take. So in this case, it worked out. All right, so how do we calculate the depletion once we set up our basis? Well, to calculate depletion, the first step is to determine the depletion unit. And that just, you divide your adjusted basis of your timber by the pre-harvest volume. And then, using that depletion unit times the number of units harvested. So I'm going to show you an example in this case. So you sold 50,000 board feet out of the 100,000 board feet of saw timber in your property, and 600 cords out of the 1,000 cords of pulpwood in your entire property. So in this example, remember, 10 years ago when you bought the property, you had 72,000 board feet of saw timber. So 10 years later, let's assume you have 1,000 board feet of saw timber now, but you only sold 50,000 board feet. And similarly for pulpwood, it's the same thing. Now, how much is your depletion deduction? How do we calculate that? Well, the first number, 21,457, this is the basis for your saw timber that we calculated. So divide that number by 100,000 board feet. That gives you the depletion unit. And then times 50,000 board feet of saw timber that you sold, that gives you $10,728. That's your timber depletion for saw timber. For pulpwood, it's the same thing. $11,477 is the adjusted basis that you set up for your pulpwood. Divide that number by 1,000 cords, give you the depletion unit for pulpwood times $600, 600 cords of saw timber of pulpwood you sold. That gives you the depletion for pulpwood. So the key is to establish your basis. Now, what if you inherited the property, and what's the basis for inherited the property? Well, the basis for inherited property is the fair market value of the timber on the date of the decedent's death. That's the definition. So here's another question here for you. If I inherited the timber property 10 years ago, does this mean I have to go back 10 years to establish or estimate the fair market value of my timber to set up my timber basis? All right, go ahead and make your selection on your computer. All right, yes, this is correct. So the reason why this is correct is that the definition of the basis for inherited property is the fair market value on the date of the decedent death. There's a little bit exception on alternate valuation date 6 months after, but basically we need to go back 10 years or however years ago we acquired the property to set up the basis for inherited property. If the property was inherited long time ago, 30 years ago, it may or may not be worthwhile financially to set up the basis, because the basis for your timber might be low at the time when you bought that, when you inherited it, so it may not be worthwhile to do that in that case. Okay, let's look at what cost can you deduct on your tax return if you own timberland. Here are some of the examples of deductible items. Tools of short useful life or small cost, hired labor, fees of consultant and accountant, attorney, property tax, your annual property tax are deductible, the cost of prescribed burning, the expenses of fire, insect, and disease control and protection, the road and fire break maintenance costs, and overnight travel. How do you report expenses on your tax return? You deduct expenses for an investment property as miscellaneous itemized deduction on Form 1040 Schedule A. The investment expenses, including the timber management expenses, if you own timber as the investment property, are deductible only to the extent that combined with other miscellaneous itemized deductions, they exceed 2% of your adjusted gross income. So they are subject to this adjusted gross income floor here. What about for business taxpayers? In that case, you deduct your business expenses on Form 1040 Schedule C if you materially participate in your business and there's not a adjusted gross income floor limitation here. Form T. This is a special tax form for timber transactions. And let's look at the parts that made up Form T. Forestry Activity Schedule. This tax form has 5 parts. First part is acquisition. So when you purchase, inherited, or someone give you a property, that's the time when you fill out the first part, acquisition. Timber depletion is part 2. We just calculated a depletion example. Part 3 is profit loss from land and timber sale. Part 4 is reforestation, timber stand activities. And then ownership is when you sold your land. When the land changed hands, that's where when ownership changes, and you will fill out this part 5 here. So who is required to file Form T, and what are some exceptions? First, it's imprudent to file when you claim depletion deduction or if you sell business timber. So it's, even though you're not required to file, but it's prudent to file when you claim depletion or you sell business timber. The exceptions to the required filing is if you are an occasional timber seller. Occasional timber sellers are not required to file, and the occasional is defined as 1 or 2 sales every 3 or 4 years. So for many small woodland owners, they fall into this exception here. Okay. Now let's look at the payment that you received. It also called cost share. Are those taxable? In general, cost share payment must be included in your income unless it qualifies for income exclusion. exclusion is good in this case because your income is not subject to tax if you can exclude that from your income. Okay, so in order to qualify for income exclusion, here are the two requirements here. The excludable cost share payment must be from an approved program, federal or state program. It also must be used for capital expenditure for capital projects such as reforestation. So if you received a cost share, even if they are from an approved program here, but if you didn't use it for a capital project, for example, if you thin your forest, that's not a capital expenditure, it's a deductible expense, then you cannot exclude that cost share from your income. So what you do in that case, you include cost share as income, but you take a deduction on the expense side because you spend that in thinning your tree stand. Okay, Form 1099. This form is a special kind of form. As far as how to report on 1099, it's a little bit different than a normal tax form. So this form works like your W-2 for a landowner who made a timber sale. You use 1099 to file your tax return, and you do not file 1099 if you're a landowner who just sold timber. We will look over who is required to file Form 1099. And the person that is required to file 1099 must issue this form to the landowner and also to the Internal Revenue Service. So there are two sides on this. Now, timber sales are subject to 1099 reporting, whether they are pay-as-cut or outright sale. This is an especially important subject for the foresters who help landowners conduct timber sales. So just remember also, if you receive cost share payment, you may receive 1099-G that shows the amount of payment that you received to help file your tax return. All right. So who must file 1099-S? 1099-S is for real estate reporting, so that includes timber sales. The first person in line to file 1099-S is the person, including attorney or title company, responsible for closing the transactions. So if there's a title company involved, they'll take care of this. The second person is the mortgage lender. So if you take out a loan from the bank and involve the selling of the timber, then the mortgage lender will do that. The seller's broker and then the buyer's broker. If none of the first four is available, then the buyer is responsible for filing 1099. And also, there's a very important tip here is that as far as where to get the 1099 forms, do not go to the Internal Revenue Service website and download that form, as that downloaded form from the Internal Revenue Service website is not scannable, and you may have to pay a penalty for using a form that's not scannable. To order official forms, you call 1-800-TAX-FORM, and the Internal Revenue Service will mail you the scannable forms. And there are also web-based software you can pay to use that, and that also works. It's just the Internal Revenue Service does not provide a fillable form option. There are also other substitute forms that you can use from a private printer, or you can even develop yourself, but you must comply with the requirement specified by the Internal Revenue Service. So you want to check the tax year on the forms. Sometimes they mail you the tax form with the wrong tax year. So if you already fill it out and only later find out it's for the wrong tax year, so that doesn't help at all. Here's the deadline to file 1099. So the first one is the deadline due to the payee, in this case our timberland owner who sold timber, and that is at or after closing, but by February 17th, 2015. That's the deadline to the payee. The deadline to the Internal Revenue Service is March 2nd, 2015 on paper, or March 31st, 2015 if you file electronically. If you need more time, you can request an automatic 30-day extension to furnish statement to the payee. And you do that by writing a letter or electronic request to the Internal Revenue Service. You can also request an automatic 30-day extension of the time to file 1099 with the Internal Revenue Service by filing Form 8809 by the due date of the return. You don't need to sign and you don't need to explain. And we already covered that point here. All right. There may be a tax penalty for failure to file Form 1099 without a good cause. The amount of penalty is based on when the correct form is filed. The penalty is $30 per return if you correctly file within 30 days and the maximum penalty is $250,000 per year in this case if you file within 30 days. And the penalty becomes $60 per return or per form if you correctly file more than 30 days after the due date, but by August 1st. And then it's $100 per form if you file after August 1st, or if you do not file required form at all, and the maximum penalty can be $1.5 million per year, and that's $500,000 for small business. Okay, now let's look at the forest planting cost. It's also called reforestation. There are special tax incentives here too. Here are some of the examples of reforestation cost. Hired labor, seedling cost, site preparation cost, the equipment cost, and the cost that you do to do computation control to establish trees, normally in the first 2 years. All right, you can deduct outright the first $10,000 per year of qualifying expenses per qualified property. The $10,000 is for merit filing joint. If merit filing separate, that's $5,000. And in addition, if you have more than $10,000 reforestation cost, you can deduct or amortize, the term is, any additional amount over 8 tax years. So let's look at an example how this calculation works. let's say your total cost of reforestation is $14,000. You can take $10,000 deductions in the first year for joint returns. And we have also the $4,000 additional over that $10,000. And here is how you do your amortization deduction. First, you divide $4,000 by 14, and that's because of the half-year convention accounting rule. So divide the 14 and 7 are fixed. Those two numbers are fixed. So 4,000 divided by 14 gives you $286, and this is the first year. You can also take 286 plus that $10,000 right here. For the second year, third, fourth, until the seventh year, $4,000 divided by 7 give you $570. You take $571 for year 2 to 7 each year. And then in the last year of year 8, you take $286 for reforestation. If a trust owns a timber property and the trust have done a reforestation, and the rules are a little bit different, a trust cannot take the $10,000 deduction. However, a trust is eligible for the amortization deduction. How do we report reforestation? For investors, you take the deduction on the front of Form 1040 as an adjustment to income. So what you do is you write reforestation and the amount on the dotted line for the adjustment to income, which is in the first page of 1040. There is not a specific line for reforestation, so you write it there by yourself. For participants in a trade or business, you take the deductions on Form 1040 Schedule C for business, or on Schedule F if you're a farmer, and you use the other expenses line to take that deduction. Also, you must specifically elect to amortize reforestation expense on a timely filed return, including extension. So if you take the amortization, you're going to need to make this election. You do this on Form 4562 Part 4, also on Form T if you are required to file. Also attach a statement to your return showing the following four things on it. Attach a statement meaning you write all of these on a blank piece of paper and attach that to your return. First one is unique stand identifier. The unique stand identification number is basically asking you to clearly show the specific property that is reforested. You can't combine that with the rest of the property. It just must be separately documented. That's what that means. So for a lot of small woodland owners, even if they don't have unique stand identification number, you do need to show clearly where the specific property that is reforested. And total acres reforested during the tax year, the nature of reforestation treatment, artificial or natural regeneration, total qualified expenditures eligible to be amortized or deducted. Okay, timber loss. Can you take a tax deduction if you lost your timber due to fire, storms, or theft? Yes, you can. However, the amount of your deduction is the lesser of the fair market value loss of your timber or the adjusted basis of your timber. So you can see it's important to establish your basis to claim a casualty loss here. Now, if the return from a salvage, harvest, or court award, if this is a theft case. The court awarded, you are able to find whoever stole the timber, and then the court awarded the amount to you. Or insurance claim, if those income exceed your basis of your timber, you will have a gain. You can still claim the casualty loss, but if you've done a salvage sale and if you got court award that exceed your basis, you have a gain. If you reinvest the gain into timberland by reforestation, purchase more land, that gain is not taxable. You can defer tax on that gain. Otherwise, you have a taxable gain. All right, so that concludes our formal presentation. If you want to find more information, this publication, Federal Income Tax on Timber, a quick guide for woodland owners, is a useful guide with good examples, show you how to calculate and how to file your return. We run out of the printed copies. You can always keyword search. You can search on the internet using the title and get an electronic copy.